Okay, hello everybody. Give me just a second and I will connect the file that we will be using. I emailed the file to you, so you should have it. Let's see. Okay. Okay, so as usual, when we do these sessions, if you have a question, please use the chat box. I have it open here so that I can see it. And I think that's just about it. So in this video, I'm going to be going over the questions that I sent you, and not the file that I sent you that has many of the questions that are on the final exam. I shouldn't say the topics, not the questions themselves, obviously. And so we'll just go ahead and get started. I am recording this so that it will be available probably a little bit later on this evening after we're finished. All right, so the first one that we have is that Smith Company declared a 15% stock dividend on the 31st of March, 2020. All right, the stock price on that date was $29.52 per share. Before the stock dividend declaration, the balance in the common stock account was $400,000. Common stock has a par value of $1 per share. So to record this stock dividend declaration, and we're going to go through these 4 items here. Let me see. All right, so the 4 items that we have here is these different accounts. The common stock attributable, I guess I need to add here, account, will it be debited, credited, or neither, and for how much? Well, we're going to have to do a little bit of work here to figure out how much is going to be distributed, how much is going to be recorded in the common stock distributable account. So first thing we need to know is how many shares. Oh, sorry. Shucks. Sorry. I need to just move this thing out the way. Okay. How many shares? All right. Common shares, I should say, are outstanding before the stock dividend. All right, that's the first question that we need to know, because we know that the stock dividend is 15%. And to find the answer to this, what we're going to have to do is link together 2 other bits of information that are given to us. Recall that the common stock account, whenever shares are issued, only the par value is credited to the common stock account. So let me just add that here. All right. Note, only par value is credited to the common stock account when shares are issued. So we know that the par value is $1 per share. And we know that the common stock account has $400,000 in it. So how many shares does this $400,000 represent? And in this case here, it's $400,000. And each share has a par value of $1. So this means that there are 400,000 common shares outstanding. Okay. Okay, I'm just going to move that up here. All right, so there's this here. So there's 400,000 shares outstanding. That's number one. Now, we've got to continue here because there is a 15% stock dividend. So therefore, if there's 400,000 shares and the company is issuing a 15% stock dividend, then with this stock dividend, they're going to be issuing an additional 60,000 shares. And each share has a par value of $1. So we have 60,000 shares times $1 par value, and that is going to be equal to $60,000. And this is the amount that is going to be credited to the common stock distributable account. So in this case here, the correct answer is the common stock distributable account, all right, will be credited for $60,000. All right, any questions? Okay, let's move on then to the next part of the problem. Next part of the problem asks us, the additional paid-in capital common stock will be debited, credited, or neither for how much? So let's take a look here. The information tells us that on the 31st of March, the stock price was $29.52 per share. So when there is a small stock dividend, a small stock dividend means less than 20 to 25%, then we are going to transfer from retained earnings into the common stock and the additional paid-in capital accounts the fair value. And the fair value is $29.52 per share. So we know that they are issuing 60,000 shares, and additional paid-in capital is going to be credited for $29.52, which was the market price when the dividends were declared, minus $1 par value. All right, so therefore, it's going to be 60,000 shares multiplied by 28.52. And that is equal to 1,711,200. Okay, now what I want you to do is, and just send me in a, oh, and this is going to be credited, so let me just add that here. So the common stock distributable account will be credited for $60,000, and then the additional paid-in capital will be credited for the difference between the price per share and the par value times the number of shares. And this gives us then the $1,711,200. Okay, so now I'm going to give you a chance to answer part C. So if you'll go to the chat box and just send it to me, and you should have two things in your answer: debit, credit, neither, and then a dollar amount. Okay. So I'm going to give everybody a moment or two to work on it. All righty, so recall that when there is a stock dividend, there is no cash that's involved. All right, so then the correct part here would be neither, and the amount would be 0. And then finally, the retained earnings account. And just note here that the retained earnings account is going to be charged or reduced by the fair value of the shares when the stock dividend was declared. So recall from above that we said that there were 60,000 shares that were issued in relation as a result of the stock dividend. Okay, so we have 60,000 shares, and retained earnings is going to be charged the full amount of the value of those shares, which was $29.52. And so 60,000, excuse me, times 29.52. Hold on a second here. 60,000 times 29.52. Okay, then this is equal to 1,771,200. So then the answer here is going to be 1,771,200. And notice here that the amount that is debited to retained earnings is equal to the sum of the 60,000 par value plus the additional paid in capital. Now I've added here a little sheet, because what I'm going journal entry sheet, because what I'm going to do is now record the journal entry that we would prepare when this stock dividend was declared. So we're going to debit retained earnings, and we debit retained earnings for the amount that's going to be taken out of retained earnings, and that's going to be face the fair value of those 60,000 shares. So 1,771,200. Okay. And we're going to credit now common stock distributable, and this distributable account, then when the stock is actually issued, this account will be debited and common stock will be credited. And then we have the additional paid in capital. Common stock. And that would be for $1,711,200. All right. Are there any questions on this part in terms of determining dividends? And I mean stock dividends, recording stock dividends. If not, I will then continue to the second problem. All right, during XYZ's first year of operation, the company issued 150,000 shares of $1 par value common stock. The issue price was $25 per share. And during the year, the company reported net revenues of $580,000, expenses of $318,000, and dividends of $1 per share were paid during the year. So what we need to do is to compute the year one net income. All right, now, what I want you guys to do, if you'll just go to the chat box, and then when it says to, just send it to me privately, and I would like you to submit, well, let's say the first one, just the year one net income. What is your computation of the year one net income for XYZ? All righty, well, I'll go ahead then and continue with the calculations. So we know that the $580,000 was the revenues minus the $318,000 of expenses, and this would leave $262,000 of net income. Now, the question asks, well, what's in retained earnings at the end of year one? And recall that retained earnings, the beginning balance for XYZ is going to be zero because this is their first year of operations. All right, so we're going to say it is zero beginning balance plus the net income, which was $262,000, and then minus the dividends. And they say that dividends of $1 per share were paid during the year. So it was 150,000 shares, and each share received a $1 dividend, so that would be 150,000. And that means then that at the end of the year one, the retained earnings account will have $112,000. So I'm just going to repeat this. We take the beginning balance, which in this case was zero. We add the net income, $262,000. We calculated that in part A. And then we're going to subtract away the dividends, and we can compute the dividends because we know that there were 150,000 shares that were issued, and those shares each received a dividend of $1. So now a little time for you. I want you to tell me what is the balance in the common stock account at the end of year one and the balance in the additional paid-in capital accounts. All right, so okay, now in this case here, notice that they tell us that they issued 150,000 shares. There is no information that they bought back any of those shares or that they issued more shares. So therefore, the common stock account is going to have, well, 150 shares times $1 par value, and that will be then $150,000. And then the additional paid-in capital will be still 150,000 shares, but now it's going to be multiplied by $25, which was the issue price, minus $1, which was the par value. And that is going to be equal to 150,000 times 24, or $3,600,000. All right, I'm going to pause for a second. Do you have any questions? You can send it to me on the chat, or you can unmute yourself and ask a question out loud. And rest assured, there are no bad questions, because inevitably, a question you may ask is a question that somebody else who watches this video later on may have wanted to ask. All right, I'm going to keep on moving then. I'm going to move to question number 3. All right, Yardar has investments classified as trading securities on the 30th, and let me just sort of emphasize this here, the 30th of December 2018 as follows. They have 200 shares of Alpha stock, and the total value is, not value, but the total cost was $10,488. They also have 1,400 shares of MYB company, and those had a cost of $64,078. And then they have $8,500 of BEHG, and those cost $86,700. So at the 31st of December, and this is then, the end of the fiscal year, they tell us that the price per share of Alpha, MYB, and BEHG were $54.87, $39.18, and $11.45 respectively. And what we want to do now is to compute the unrealized gain and loss for each investment. So at the end of the year, Alpha's 200 shares are worth, well, they're each worth $54.87 each. And then what we're going to do is subtract away the value that, what they had their cost before. So 200 shares times 54.87 is equal to $10,974. That's what it's worth. And then we're going to subtract away the cost. And so now we have $486. And this is a gain. All right, there's a positive amount. For MYB, all right, a yarder owns 1,400 shares, and each share is worth $39.18. All right, so 1,400 times $39.18 will give us the fair market value at the end of the year. And we need to then subtract away what was the cost, $64,078. So 1,400 times $39.18 is $54,852. All right, so I'll just repeat that, and actually I'll send you the amount. Okay, so MYB fair value at the end of the year is $54,852. But we need to subtract away the $64,078, sorry. And so what we have here now is a $9,226 loss. Okay, and the formula for that is 54,852 minus 64,078, and that gives us then 9,226, the loss. All right, and then for BEHG, they own 8,500 shares, and it's worth $11.45 a share. And then we need to subtract away 86,700, which was the cost. And so 8,500. Actually, let me just cut it. Sorry about that. All right. So 8,500 times 11.45 is equal to 9,160. And no, that's not right. Let me say that again. 8,500 times 11.45 is, sorry, is equal to 97,325. And this is, oh, brother. You know what? I wish I need to kind of erase everything. Let me try it one more time. And it's not equal to a negative. It's equal to a positive 97,325. All right, so ignore those first two because I was wrong on what I sent. Now, we still need to subtract away the cost, which was 86,700. So we've got then a gain of 10,625. Okay, all right, so overall on their portfolio, all right, this is the total unrealized gain slash loss is the sum of those three. So 10,625 minus 9,226 plus 486 leaves us then with $1,885 as the unrealized gain. Now, this unrealized gain here, because these are trading securities, and let me just emphasize this up here, these are trading securities, so this unrealized gain is going to be reported in the income statement. If they were available for sale securities, then this unrealized gain would be part of other comprehensive income and reported separately in the equity section of the balance sheet. All right. I've got a notification here that there's just like 8 minutes left on this meeting. So what I'm going to do is I'm going to pause a little bit, give you guys a chance to maybe ask a question or for some clarification or whatever you may want to discuss. And you can either ask that out loud or send me a chat. And then I'm going to close this meeting down and just use the same link again, and we'll come back in and we'll start with number 4. But I'm going to give about a minute for anyone to have a question. And if you could just do me a favor and send me your name, and then that way I can see who is on this group chat. Just send it to me on the chat. Okay. All right, I'm going to close this one down, this meeting, and we'll just come back again using the same link to start the next question, okay? All right, so I'm going to end this meeting right now and see you in a moment or two again.